Michelle, you're the economist. Let's start with you. Give us a sense of what we know and what we don't know about the scale of the economic damage thus far.
Sure. So I think a good place to start is to think about the direct hit to the global economy from the coronavirus. And that would largely be through supply chains. So the coronavirus clearly led to significant economic damage in China. Factories are shut down. That's now bleeding into other countries, Southeast Asia, you're seeing it also in Italy. So the fact that factories can't produce, the fact that you're not able to see the flow of goods through the global economy is clearly a damage. It's going to hit multinational companies, and you hear it in earnings. You hear from corporates already. So that's certainly a factor, and that's going to be an issue as you get into the middle of the year, if not already, in terms of inventory drawdown and inability or unwillingness to produce. The second way that the coronavirus impacts the economy, and this is what we got a taste of this week, is through fear. And this is where it can get really problematic, is if you have this adverse feedback loop between consumer and business confidence and markets. Where markets react negatively, as they have this week, that spurs additional concern on the part of consumers, and consumers change their behavior. They decide they're not going to go and take that trip. They're not going to go to restaurants. They're not going to go to movie theaters. They're going to stay home. They're going to hunker down. And that could be a significant hit to economic performance. Luckily, we're not seeing that in full-blown by any means yet, but that is the risk factor, and that's what we're paying attention to.
Jim, as a businessman, what do you think about the supply chain issue? Before we get to the confidence issue, the supply chain issue, how long will it linger? How long could it linger? What kind of damage could that do?
So, as I think about this, it's like having a Category 6 hurricane 1,000 miles offshore, off in the Atlantic Ocean, and we don't know for sure if it's going to hit the East Coast or if we don't know if it's going to blow out of the way. And so everybody now is panicked about what can happen. Generally, they assume the worst. Nobody knows for sure what's going to happen, and so there's just an enormous amount of uncertainty. And I think that's what's ungluing the markets, and I think that's why this topic is the only topic in the news as we sit here and talk.
So we're in better shape going into this than we might have been, Michelle, because we did have some stimulus into the economy, and we've got some economic numbers even this week that are sort of indicating we're doing okay, at least domestically in the U.S. How much headwind and how much tailwind do we have?
Yeah, so the hard data in the U.S., which is not going to yet pick up the coronavirus, has been strong. It's been good, right? The labor market was improving, consumers have been spending, the housing data has been really showing nice recovery. But that all can change quickly, right? So as economists, we have to look at forward-looking indicators. We have to rely on survey data. We have to rely on what financial conditions are telling us. That's a much better indicator of what's to come. Now, of course, those can change rapidly, right? So we have to be nimble in terms of how we're thinking about the outlook. But it's going to take some time before we get confirmation one way or the other in the hard data.
Are you seeing the economy is pretty strong right now, Jim?
Yes, definitely strong, and it's been strong for a long time. We've got between 2 and 2.5% growth, real growth. So when you combine that with inflation, GDP is growing close to 5% nominally, which is really pretty good. Unemployment is very low. Unemployment claims are low. The business environment is very good right now.
At the same time, we pumped a fair amount of stimulus into the economy through tax cuts and things. Are you surprised it isn't even stronger than it is?
No, not really, because the unemployment numbers are so low. So I think the place where we're going to get more real economic growth is through productivity gains, and I think we saw that last quarter, and I think we're going to see more and more of it going forward.
You know, on productivity gains, do you think that there's been a change in how businesses are investing? Because presumably in order to get significant productivity gains, you need to have a greater willingness amongst the business community to invest. I mean, do you think that that's potentially a factor? Do you see that all specifically in your space?
We see it in terms of our use in robotics, in our plastic manufacturing. We see it in terms of just computer systems in our insurance business. We're seeing, you know, it's been 30 or 40 years that we've had this IT revolution, and until a few years ago, we really didn't get much measured productivity from it, but now I think we're really starting to see great opportunities for productivity gains.
At the same time, the expensing of capital investment should have made it take off like a rocket ship, shouldn't it?
It certainly doesn't hurt, but I don't know that it was the deciding factor.
It's really interesting, this disconnect that you see from what people say in the business community on the ground around IT and the ability for productivity to pick up and greater efficiency, because it feels like there's a lot more efficiency. But yet in the aggregate numbers that we get reported in GDP, the productivity numbers have been so subpar. So maybe it is just a function of time. Maybe it's a function of, the investment lasts long enough, the innovation continues, and you do realize this really impressive productivity boom, which is quite an optimistic story that people are not talking about, especially right now when there's so much fear out there in terms of the risks.